Hello guys, welcome to a new video, and today we are gonna discuss the strike price, right? What it is and what are the consequences if you select your strike price badly, and how that's gonna impact your overall profit and loss. If you wanna understand the strike price and how you can choose it better, then do stick around till the end of this video. I'm gonna explain all about the strike price in this. So do stick around, and with that, let's start. Okay, so I'm gonna take NVIDIA as the example to show you what a strike price is and how it works, right? And here I'm gonna go for the buy side of it. So if you are in your options chain, you see buy call. So that's basically you are buying a call, and this is buy put, right? So buy call by nature it's a bullish strategy. Buying a put it's a bearish strategy. For this expiration date, I've just selected March 21st, which is a couple of weeks out, just to show you how the premium works, right? So that's the setup. And with that, let's first understand what exactly is a strike price is, right? What's the definition of a strike price? So a strike price is the price at which you have the right but not the obligation to buy 100 shares of that stock before the expiration, right? And that is if you choose to exercise. People generally do not exercise options. So if you want to know more about why people do not exercise an option, it's a very bad idea to exercise an option, then do check out that video once you understand the strike price. Okay, so that was the definition of a strike price. And in your Robinhood scheme, you can exactly see here it shows strike prices here. So these are the strike prices that you see here. Now, if I flip to the buy put, right, then your numbers would change, but your overall idea is gonna remain same. For buy a put, the definition would be a strike price is the price at which you have the right but not the obligation to sell 100 shares of the stock before the expiration. In case of buying a call, you had the right to buy. In case of put, you have the right to sell. That's the only difference between buying a call and buying a put, right? So I'm from now onwards, I'm gonna just use buy call as my example to explain you the strike price. But do know that the similar concept applies to put side as well. Now coming back to the strike price here, the next thing that is very critical to understand is in the money and out of the money, right? So in case of buying the call that you see here, whatever prices, the strike prices that you see which are less than the current market price of this stock are in the money call options, okay? And whatever is more than the current market price are out of the money call options. So these whatever you see here are out of the money, and whatever you see here are in the money call options, okay? So with that, now let's understand three things which are very critical before you select a strike price. So the first thing is in the money call options, they have a higher sensitivity to the stock price, right? What it means is if you, let's say you choose 105 as the strike price, right? Look at the delta here. The delta is the Greek which basically tells you that for $1 move in the stock price, how much premium are gonna get increased. So what it means is if the delta is here 67, right? And if the stock price move by $1, your premium is gonna be increased by this much amount. So whatever you see here 9.85 plus 67 would be your new premium price, right? So as you can see, it's a very high delta, right? That means for every dollar move here, your prices is gonna be increased by $67 almost, right? If you go more closer to the money here, your the sensitivity to the stock price is going to decrease. So if you go out of the money here, let's say you go far, right? You go 120. If you look at the delta, it's just 30, right? So for $1 move, your premium is going to just increase by this much amount. So that's the difference between in the money and out of the money call option. To understand it more clearly, right, you can check out the option strat. I'll put the link down in the description. You can definitely check out. So in this case, let's say I've selected here, it's already, I've selected the March 21st as the expiration. And if you look at, let's say, we'll go in the money, right? So 105. So you can select 105 here, and it's gonna show you the chart, a visualization to see where you would stand depending on what prices or how the Nvidia prices moves, right? So just to give you a quick example, let's say you select 105 call right here, and let's say today's 6th, it's 7th, right? And the Nvidia has moved 214, right? So you're gonna make this much profit, and as it goes up, you're gonna this basically your profit is unlimited in case of buying a call. As long as it moves up, you're gonna make money. If it goes down, you're gonna lose money, right? But if you look at here, overall it is balanced. But if you go out of the money, look how it changes, right? If you go far out of the money that we had selected 120, you're gonna lose this money very quickly, right? In this case, as if the price doesn't move in your direction very quick, you're gonna lose all the premium that you paid to buy that contract. Okay, now let's understand the second point, right? And which is the risk analysis, right? So coming to this one, if you look at here, right? If I go in the money and select 105, right? My If you look here, right, you're gonna be paying almost $1,000 in your premium, but your risks are less compared to if you had selected out of the money call, right? To understand this more better, I'll go back to the option strat. If you see here, right, if you go to 120, if you look at your break even price, right? So to break even, Nvidia has to move right now. Remember, right now the price is hovering around 110. So it has to move almost 10 points, more than 10 points rather, for break even, right? So it has to go 11% more from where you are to just to break even. After that, you're gonna make profit. Compare that to in the money, right? So for in the money, it just have to move 3.5% to break even, and beyond that everything is profit. So if it moves just is right now around 110, but if it moves around, let's say, 115, you start making money, right? So your risk is less. Okay, the third and final, right, which is related to what we discussed, is basically the in the money options that you see which are below here, right? They are going to be costly compared to the out of the money. And the reason is what I explained in the second point, right? Because out of the money are more risky. So let's say if you're gonna buy a call at 120, you just gonna pay here $275, right? And compare that to if you have to go in the money and buy this, right? Here you are paying almost $700 more, but your chances of profit is very high compared to if you go out of the money. For an out of the money, if the look at the break even, right? They also show the break even here. It has to just to break even, the Nvidia has to go more than $122, right? In this case, but if you go in the money, Nvidia only has to move more than 114, and you will start break even on your price. So your in the money options are always going to be costlier compared to your out of the money, but it's a trade-off that you have to be well aware of. If you go very far out of the money, you're gonna be paying less money, but your chances are gonna be very slim if you go out of the money, because as you go out of the money, you remember your chances, that delta that I talked about, delta is keep decreasing, right? And as delta decreasing, your chances of making that premium is gonna be very slim. So that's the big difference when you select the strike price in the range of out of the money, or if you go in the money for the strike price selection. Okay guys, that was it for this video. I hope you understand how this works, and I'm gonna make more videos to really show you how the put side of it works if you wanna know. If you have any questions around this or any questions in general around options trading, do put your question down in the comment below, and I am gonna respond to that. I'll talk to you in my next video guys. Till then, happy investing. Bye bye.